Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Kenneth, hi. Welcome to the Equitymaster Investor Hour.
Thanks, Rahul. Thanks for inviting me.
I think we've done this before a few years ago, I think. And, it was fascinating, very thought-provoking. And I'm looking forward to today's discussion. Even more so because I think talking to you every time, whenever I talk to you, and the other day when I spoke to you over the phone, you bring in a perspective which is very thought-provoking and also seems just so much right to think on those lines. So I'm going to probe a little bit on that also, what we discussed the other day, and talk about that. But to begin with, I want to rewind back, all the way back, and ask you to share a little bit about yourself. Where were you born and brought up? What kind of education you had? The family background. What was your household like? I'm just trying to put in a frame of what was the background to, Kenneth becoming the brilliant and very popular fund manager that he's become.
That's a loaded question. That's okay. I think my real career in equity investing started off in 2002.
Okay.
Before that, I was a hobbyist investor.
Hobbyist.
Hobbyist investor, right? I also did a little bit of financial reporting at the beginning of the entire career.
Okay.
And that's where I gained. I gained the breadth of the entire marketplace. I mean, there were enough companies in the 90s that never did well. There were a few that did well at that point in time, and I think that was the foundation of it all. I came from a very fairly ordinary middle class background. My dad was in service. My mom's a housemaker. Had a brother and a sister. Very nondescript, staying in Mumbai suburbs for the longest time I can remember. I'm actually still in Mumbai suburbs. Okay, so that was the background. The interest in equity started because Dad used to invest in IPOs, and IPOs was a big thing.
Yeah.
One thing led to the other. I started working as an accountant in 1987, so could understand balance sheets. I was pretty much keyed on to making sure that all trial balances that passed me got balanced to the last decimal point. So that was a little bit of everything that I did. And because Dad invested in a lot of IPOs, that transition helped me get a job in financial journalism. It happened in capital markets in 1990. That was the magazine. And life moved on from there.
Yeah. So you said 87 is when you started, looking at balance sheets, doing the crossing the I's and crossing the T's and dotting the I's, etc. And as an accountant, you mentioned your father was investing in IPOs. Was it the mid 90s IPO boom, or was it
Earlier, it was the mid 80s.
Oh, mid 80s. Now that's something I'm not familiar with a lot.
So don't take me back there.
So, but do you recollect any IPOs anything that comes to your mind? What you guys did, and did anything play out well? Did not play out well?
I mean, one thing that I learned from that exercise is the mortality rate in whatever you hold is extremely high. Okay. When we talk about long-term investing, very few companies comes through that phase through that phase in time. So there are very, very few companies that I can remember from the 80s, and most of them are MNCs or extremely large groups.
Yeah.
And if I just applied that to it all, I mean, you have to have an investment thought process that either migrates to companies getting larger, okay, or getting larger and getting higher shares, or make sure that you don't get caught with the bottom end of spectrum of companies. I mean, valuations can be a big trap. Relative valuations can be a big trap. because there's always a company which is trading cheaper than than another one.
Yeah.
But that's not necessarily a good stock.
They're cheap for a reason. They could be cheap for a reason, and that's what you have to guard against.
So the 80s and the 90s, we saw two big IPO booms, and I know, and I've seen a lot of businesses out there that came through, and they were collecting, in today's terms, paltry sums of money. But none of them really survived, and none of them really became dominant.
I remember the mid-90s IPO boom. Oh, that was crazy. And if I recollect well, those days, the private radios had started, right? The private channels. So, I was in college and, the radio would be on and you would get all these ads. I think I vaguely recollect SR Oil IPO. I don't know what all IPOs were coming those days. And you're right. I think a lot of them destroyed shareholder value. A lot of it.
That was venture capital investing when venture capital investing wasn't there. There was venture capital investing for retail.
For retail, yeah. So tell me, where were you during the Harshad Mehta period? Were you investing? Were you out of the market? Were you just observing?
Oh yes, I was investing. I was losing money for sure.
Yeah. So take us through the 90s, because 90s is a very peculiar period, right? We had the Harshad Mehta boom. We had a sell-off. Then we had the FII boom, 94. We had the IPO boom. And then towards the end of the decade, we had the massive TMT rally. And all, of course, ended with big disasters. Harshad Mehta, the FII sell-off, the IPO boom was, of course, which turned out to be a bust, and the TMT. So tell me, what were you doing in that? Because that seems to have laid a foundation to go into journalism. So did any of that contribute to it and your life experiences in that period?
Oh, yes, there was, so unlike what we saw from 2000 to 2020 to 2022, in a better part of the cycle, the market was always going up. Of course, you had those steep falls that come through. In the 90s, markets very rarely went up, and everything you had never went up. Right? And that was my experience in the 90s. So the FI boom was very narrow. It was very mid-capish, so very small-capish companies that were not on your radar that actually did well. The Harshad Mehta rally that was there, I mean, that was a fallout right now of something called a replacement cost theory at that point in time, which was effectively the remnants of the junk bond boom in the US, right? Or the junk bond scandal, junk bond boom, and that was the remnant of that structure that played out. And then it was replaced by the first leg of FI investing in the country, and should I say the institutionalization of equity research as a career.
Yep.
Okay, and that was a very peculiar period of time because there were these large, big wallet foreign institutional brokerage firms coming in, and some of the salaries at that point in time were unbelievable, but they existed. And that was the foundation of all of that happening at that point in time. And very quickly towards the end of the decade, a lot of them started feeling the heat of it's not a big enough market. There's not enough.
That's right. Yeah.
And that was also the foundation of the investment banks that come through. Okay, the big IPOs, the big steel IPOs, etc. all came through that period of time, right? So that's what helped us through the 90s. Never made money. Actually, I can't remember a single year where I walked away with a positive. There must have been a year or two where portfolios were positive, but I can't remember that very distinctly. It wasn't very large.
But you were an accountant. You were paying your bills via accounting profession, and this was what you were doing on the side.
Yeah, actually, I had already shifted over to mainstream equity research and some elementary fund management. Accounting was more like 87 to 91, 92.
Okay. So you got into the market when it was hot. So
yeah. So I also distinctly remember that two industries, one was textiles and second was steel, metals, steel. They accounted for a very significant part of the market capitalization.
That's right.
And very quickly towards 99, 2000, they all disappeared.
Yeah. So those days, if I remember, I did go to the stock exchange, but I think it was not until 94, right? And even then, the old, even though I think the open that open trading was ending that time, but you still had the old jobbers, you know, who would wear the traditional Indian dhoti and those clothes and a topi, and they would come, and they would always talk of the price of Tata Steel and Century as benchmarks, right?
Yes, yes, yes.
And of course, there was Reliance as well. But I remember Tata Steel and Century very clearly, which is, of course, metals and textiles. So during this phase where you did not have a big year in that sense, do you remember any particular stock that was like a big winner or a big loser for you? And
No,
no,
it was a decade that that nothing really came to mind. It was just collection of a lot of information at that point in time for me.
Your 10,000 hours, your 10,000 hours in the field of research and learning.
Yes.
That 10 years.
There was a lot of legwork. There was no internet. There was physical copies, and that also was not really available. You had to sit at the Bombay Stock Exchange to get the results out. Otherwise, you were the last person to know about the results. So it was a very different. It was a very different world, and there was an enormous amount of information arbitrage also.
Yeah, yeah. You could literally, yeah, you're right. There's amazing. Uh, at some point in time, of course, you moved into journalism. What was the thinking behind that?
So around the career was 1987. I was in college. I did a lot of accounting. 1991, I moved to capital market. 1992 to 1993, I spent a lot of time freelancing in journalism.
Okay,
1993, I moved to equity research. Did a little bit fund management right up to 2002. Okay, that is almost a decade of equity research, very little fund management. And 2002, I joined the Kotak Asset Management Company. 2005, I joined Standard Chartered Asset Management Company. It got acquired by IDFC.
IDFC. Yeah.
And now you're talking to yours truly, entrepreneur.
Yeah. So yeah, sorry, I mixed up my years. So you of course entered fund management. Now tell me, what I'm very keen to understand is when you went into fund management. I think those days I was involved in an initiative which was researching mutual funds, right? And we zeroed in on your performance and your stock picking when you were at Stanchart, and then it became IDFC. And I'm not sure whether I met you those days, mid 2000s, or my colleagues met you. I just slips my mind. But how was that? How was the transition? I don't think most people understand how do you graduate from someone who's researching stocks to becoming a fund management. Talk to us about what it takes to make that shift, both from a skill perspective and also a mindset perspective.
So it's a self-learning process. At least for me, it was a self-learning process. And I think the big shift. I was very lucky. The first fund I got to manage was a fund called an MNC fund.
Okay.
Right.
Now, the Kotak MNC fund, right? Yeah. Okay.
Yeah, the Kotak MNC fund, and not too many people knew, but if I looked at my universe in those days, in 2002-3, the universe was 51 companies.
Wow. Okay.
Okay, and if you had to, and today if I had to identify my style of investing, is that you put into a box, okay, and you got to optimize it. So you're not given a choice. So when I say I was very fortunate to be in that, out of 51 companies I was running, I mean, we were having about 15 companies. So it came very easily to me how to size a position. Okay. And when I say it came very easily, is that you had no choice.
Okay.
And which is why till date I don't see the need to have more than 30 companies on my portfolio. I prefer to have them at 20. And that's diversification as far as I'm concerned. So today, even if it's $1 billion product or hopefully a $2 billion product someday, I would still like to optimize that box out there. So 20 companies, 20 businesses. So going backwards and coming on, how did I make a transition? I guess I was one of the fortunate few to get a product which not too many people get to optimize. But that helps you think in terms of sectors. It helps you think in terms of picking uh, uh, picking businesses which are picking. So on a scale of 10, you might like 10 companies, but you're pushed to
Select a few.
selecting just that one.
Yeah.
And I think that's how that transition happened. So moving from equity research to funds management, I don't think I struggled too much, and also because it's the character of the product that was given to me to manage. So I'm very comfortable holding 10% of my portfolio in one particular.
Yeah. So you mentioned the word position sizing, and so this is one thing I think it's come up in the investor hour earlier as well in our other discussions. I think a lot of people underestimate the importance of position sizing. You may get a great stock, but if you don't allocate well, you got a problem. You may get a pathetic stock and you may allocate a lot. So like we tend to say in our writings at Equitymaster as well, that at a much larger level, in the long term, asset allocation will probably have a disproportionate impact on your overall wealth. Similarly, in a portfolio, position sizing is very important.
Yes.
So talk to us a little bit about position sizing. How should one go? How do you go about it? Are there any learnings? And also, when you say with conviction that even if you had $1 billion or $2 billion fund, and you could have 10% in a stock, where does that conviction come from?
So convictions are never built overnight, right? And I think the simplest way and how we start off is like go equal weight. You got a portfolio to manage. You got 20 companies. I don't put my conviction on one particular company. Says no, this is the thing that's going to. Okay, so 20 companies, 4.5%. You got your 100% invested. Right, year 3 after putting that together, the differential between the top 10 and the bottom 10 starts showing up. And when some of those companies go up to about 10% of the portfolio, it pushes you to, then it pushes you to think whether I should take money off the table or I'm happy to hold that on. And I think that's where conviction starts playing out. So the first is the first leg of putting our portfolio together, is pick up 20 companies with almost the same characteristics.
Got it.
Financial characteristics, valuation characteristics, and put it together.
Like a basket. You have a basket approach, but then you let your winners run, and that's what they become a larger portion of your portfolio.
That's right. But when putting it together, the prerequisite of all of this, and this is also comes to something called an investment style. The prerequisite is there shouldn't be a style drift in the way you pick stocks. Okay, there are certain parameters that you like. You like to fit a stock with valuations. If you like to fit a stock with growth, you pick your choice and pick your investment style. But make sure that all those 20 companies that you build represent the same style that you bought the first company with.
Got it.
Okay. Now, why do you do something like that? So I've been at it for the last 20 years, probably more, in terms of putting portfolios together. And to a very large extent, subconsciously, you know what has worked for you, and subconsciously, you know what has not worked for you. Okay. And I can quantify that also. So that subconsciousness, you can quantify how it comes into numbers. So the reason why you put that all together, 20 companies, the same parameters, different industries. Okay, because every industry has got a different cycle, and then your portfolio starts emerging. Okay, some industries struggle, and some industries actually do well. Okay, but that 4.5% positioning that you do starts increasing to 10%, and some of the companies that belong to industries that are struggling continue to be where they are, so they're completely outshadowed by the others, and that's where we come. That's how I've been able, and that's how experience has brought my portfolio to where it is.
So your position sizing is effectively a result and not a starting point.
It's not a starting point.
That's a very, very interesting approach. The other day for our podcast, we were speaking to Alok Jain, who's a momentum stock picker, and he does the same thing. He said, "I just pick a basket." But he's of course looking at it from a different parameter as against yours. He's very clear. I look at basket. I don't worry about individuals to begin with. I have a basket,
Yes,
and I expect the basket overall to do well.
perfect.
And we're talking again 1 week later, and we're talking about the same thing.
Yes, because I have to push probability of being right. I am not getting into the game of being certainly right.
Interesting. Because the point you're trying to make is if at the beginning you're picking the stock as well as you're deciding the allocation, you're making more than one bet at the same time, and that doesn't work in favor of your probabilities, I guess. It
Yes.
lowers your probability of success.
Yes.
That's something that one can learn from, as our viewers can learn from, and then automatically over time you would have a portfolio with weightages which reflect what it should be. The winners
Yeah.
having more of your portfolio, and the losers having, not the losers, the relatively underperformers having lower things.
Yes, but then that also brings me to the second step of portfolio. 3 years or 4 years later, I mean, there are some that will exit the portfolio.
That's right. Yeah.
Okay. But it's more critical on how do you scale up your bottom end of the portfolio. So there's one company. So if there's a business that consistently does well,
Mhm.
okay, but profit pool in the industry is not increasing.
Mhm.
Okay,
Okay.
but it dominates the profitability of the industry. The problem is not of the company, the problem is of the industry.
So no matter how well it does, it'll always be hit by the upper bar.
Yes. But every industry is cyclical in nature. So you have to continue to resize that part of the portfolio, or that company back.
Interesting.
Okay. So never, because what do we tend to do? We tend to buy the same parameter, irrespective of the industry. Same parameter, and if that parameter continues to remain as efficient as it was when the day we bought it, on a small allocation, I'll reset that allocation.
Okay. So, okay, we need to talk a little bit more about this because it's a little technical, but and I think we should talk about it because this is something people can imbibe and kind of learn from. So, when you are talking of dealing with the bottom part of your portfolio, let's say 4 years down the line, it reminds me of two things. And tell me whether I'm right or wrong. The first thing, it reminds me of Jack Welch. And in the context that if you want the company to do well, you deal with the bottom part of your employees. And if you just keep working at that, over time, you'll just have a better employee pool and the company will do better. So you're trying to deal with that, right? The other thing it reminds me is that you don't want to lose money. So you get rid of the stocks which haven't delivered and have a potential, I guess. It goes by the theory of if something is not working, it's not working for a reason. And maybe maybe you don't know something the market knows. So you're willing to exit those. So you're basically left with only the winners over time. And naturally, there's momentum in your favor to succeed because you got winners in your portfolio. Yeah, broadly on those lines?
Broadly on those lines. But on the exits, I'm willing to nurse my losers also, as long as I have a reasonable insight on what's going wrong.
Yeah, and that's where your experience counts. For a layman, it can end up being a bias, right? Or worse, ego. But in your case, it's your decades of experience which can tell you, you know what, I can wait it out because I think the market will take note.
Yes. I think once, and that's been my experience, whether I was with Standard Chartered or with Oldbridge. It takes a good 3-4 years for your portfolio to settle down, or maybe 5 years for your portfolio, and then you're on the journey.
How do you deal with your winners? Do you just keep letting them run, or at some point in time you take money off the table?
No, we take money off the table. I have to reallocate it to some of the ones that are not doing well.
Not performing. So here's the thing, right? If you read the literature which most of our viewers read, right, about Buffett, about anyone, they say buy and hold, right? But if I look at what Buffett is doing, I can see he sells as well.
Of course.
Right? But and if I look at myself, we all, again, it's a bias. You own a stock, and I don't think many people actually ever book a profit. They want to just hold on to it, and just as the reason they don't want to sell, exit a loss-making position because it's painful to book a loss. But is that what differentiates a fund manager or a professional money manager from a hobbyist, if you will, where biases take hold, and that's what sort of puts pressure on our overall performance over time?
So my ex-boss taught me this, is that your NAV, your cost of holding your company is not the price you bought it. It's yesterday's closing price. You got to decide on yesterday's closing price or last week's closing price, if you're not watching prices every day, whether the rationale of holding that business still holds true. Okay.
Yeah.
So there are a lot of investors who keep asking me, okay, because I had this legacy of buying a lot of these consumer names in 2008 to 2013 that did very well, right? And why are they not represented in my portfolio at this point in time? So I just go back and I just take one step back and I say, in a lot of these cases, in 2008 to 2013, I bought companies and businesses where the valuation framework was in my favor. Now, what was the valuation framework? Their earnings yield, okay, was significantly higher than your 10-year G-Sec. Okay. In today's context, for me to justify that argument, though they are great companies, okay, it's very, very difficult. The reason why I'll buy it today has to be completely different, and that's a style bias if I do it today.
Yeah.
So that's a style trip. That's a style bias. Okay, that's a style trip. So that's essentially why I continue to look at just one parameter of financial numbers, ratios, etc., and create companies which are like of very similar characteristics within the portfolio.
Yeah. Okay. So just for the viewers, earnings yield is nothing but earnings divided by price expressed as a percentage. Cost of money is what is given. So if a company is making a profit of 100 rupees on a share price of 1,000, so it's basically giving you a return of 10%. It may not come to you because the company may be reinvesting the money, but 10% vis-a-vis if the cost of government money is 5%, 6%, 7%, so you are better off or worse off. Broadly speaking, that's what Kenneth is referring to. I want to step back a little bit, Kenneth. When you said you try and select 20, 30 companies across industries, but you're looking for certain commonalities. What, at the risk of simplification, which is that one metric that you rate the highest when selecting companies for your portfolio across sectors?
It's got to be the largest in its industry and have the best financial metrics in its industry.
So when you say largest, given other things are the same, you're already looking for a winner.
Yes.
Okay. And best financials could vary, I guess, I assume, right?
Yes.
What do you mean by, some companies, whether they have debt, don't have debt, profitability, etc., etc. So tell me something. When you say you're betting on winners to begin with, you said largest, you said best. Where does valuations play a role?
Okay.
And the reason I ask this is because, incidentally, these days I'm reading a book which at times makes a case that don't get too hung up on valuations, because good companies are expensive for a reason, and they can stay expensive for a very long time. And we've seen that in India in the case of the MNCs, which you've really done studied over the years. So talk to us about that a bit, please.
So let me get so the preconceived notion is a good company, a great company, a largest company in a particular industry always comes expensive.
Yeah. Good to
What
check.
happens if that industry is not making money?
Okay, fair
Okay.
point. They'll be the worst hit if the industry is doing well, bad. Probably.
Okay, so my biggest
Yeah.
learning experience is from one of the worst commodities that anyone can put up a industry around. It's sugar,
Okay.
right? I think it was 1999. The entire industry made a loss, and Balrampur Chini came with a profit of 30 crores.
Very interesting.
Okay. I think the market cap was somewhere around 150 crores, 160 crores. Today, the same market capitalization would be northwards of about 8,000, 8,000 crores. And in every cycle, there was one new company in the sugar industry that hit a 10,000 crores market cap. The first cycle was Bajaj Hindustan. The second cycle was Sri Renuka Sugars.
Okay. Mm-hmm.
Now, for all of us who are financial analysts, we all always tend to believe that return on capital employed or return on equity is a measure of capital efficiency. So my journey is between so our investment journey is between a 7-8% return on capital employed to a 30% return on capital employed. Why does a good company trade cheap? A good company trades cheap because the industry profitability is collapsed. Okay, which takes me back to the point. It's become a business which is the largest in its category, where he's having the lowest margins in this business, irrespective of where the valuation stands. When the cycle changes, you're back to 15-16% margin and you're over.
There'll be a big beneficiary when the cycle turns around. That's the point.
All we do. So we don't wait for return on for capital efficiencies to show up before we step into the business. We like to be large shareholders of a category wherein you've got very depressed valuations, but a very valuable asset base.
Okay.
Okay, you go back to a very efficient business right through the last 20 years, which is Coromandel Fertilizer, right? Every down cycle, he got higher market share. End of story.
Okay.
Okay, you go back to Chambal Fertilizer. I mean, this is a fertilizer business. There's not, and why I talk about fertilizer business, there's no investment in the business because the private sector is shunned it. You're operating in one of the most inefficient industries ever, regulated and inefficient. And look at the money that they've created. And this is not money in terms of wealth to the investor. I mean, that's also happened in the course of time, but in terms of just sheer cash flow and profitability of that business. And this is a government-facing business. Right?
So, okay. So let's try and just revisit the steps. So I am understanding this. Large companies, they are getting, if the overall industry profitability is low, the large companies in that, of course, have all the numbers suppressed. But you're trying to get into them at that stage, because when the profitability turns, they will probably be among the bigger beneficiaries.
Okay.
Right. So typically, a lot of people say we are bottom-up investors. We only focus on the company and how well it does. You seem to have like a little bit of a top-down approach. You're looking for sectors going through cycles, and within that, you're trying to find the right company. Is that kind of sort of differentiates your style from some of the very typical bottom-up stock pickers?
I think subconsciously everyone's looking at the similar metric. You always start with the company.
You always start with the company.
You always start with the company, and obviously a company, a large company not doing well. Every single investor over this sort is always visiting the company, knowing that the time will come. It's the time of entry, which is fairly critical. I do it on the downside. Someone waits for it to turn around before they step in. That's where it is.
Got it. And give us, so you've obviously given us a couple of examples. You've given us in fertilizers, you've spoken about sugar. So we're of course going to stay away from stock recommendations and all. That's not a beat at the investor hour. But talk to us about industries. If you can talk about one industry today where you're seeing suppressed profitability and which over the next few years could see such a trend play out?
Hmm.
Just to give a sense in the context of the times we are in.
Real estate?
Okay.
Hmm.
So let's take that as a case. So real estate has been through what 7-8 years of a bear market in terms of the real property cycle.
Hmm.
So there's a problem there. So the industry profitability is suppressed. You have companies over there with long track records. So you're looking for stocks in that space which are large, which have of course suppressed numbers, and then you're saying you can get in, and as the cycle turns, you can ride it. And if the company does better, becomes more efficient, you ride it even more, right? That's the kind of story. Okay, very interesting.
So if you go back to 2008, everyone was wanting to do real estate, right? DLF
That's
went
correct.
almost the largest stock. 2000 from DLF hasn't revisited its all-time highs.
I don't think it's going to revisit in a long time, right? Wasn't it like a 90% fall from the peak, right? Some
Shobha is trading still around its IPO price in 2007.
Oh wow. Oh,
Okay, and
real
all the
estate.
other guys around that space, I mean, you name all those numbers that were there, they're all decimated, they're all gone.
Wow. So different industries have different cycles, right?
And,
So at any point in time, so when you're constructing your portfolio, you're tracking all these trends, and whenever you see the trend, you make switches and sort of get them into your portfolio, right? That's all.
yes, it's not like I wouldn't say it's as simplistic as this. So yeah, but yeah, we are alive to a lot of things happening around us. More importantly is where the quality of balance sheet of a lot of companies are improving. Quality of a balance sheet improves. There's low growth in the industry. Those things we love.
Yeah.
So to put it financially, we all calculate return on equity or return on capital employed. In this case, return on capital employed.
Mhm.
So return on capital employed has got two variables: the numerator and the denominator.
Mhm.
Okay, capital employed, and the top line is PBIT.
Yep.
Right? A lot of investors tend to project the numerator. Okay, but the efficiency is in the denominator. So if you're a bottoms up investor, you have to consistently keep looking at how fast I'm shrinking my numerator for the same, how fast I'm shrinking my denominator for the same numerator.
That'll have a big impact on the returns.
Yes.
More efficient. Yeah.
So we are not macro investors. My single metric is how much can a management squeeze its denominator, right? In an environment which is declining, or in an environment which is static. Okay.
Great.
Now, when the largest company in that industry is doing that, okay, and still keeping its head above water, I mean, the industry itself is not adding capacity. Right?
Mhm.
So the macro offshoot of that is that if an industry is not adding capacity, someday the pricing power will come back, and then the focus will come on the numerator.
Got it.
But there's no point in having a focus on numerator if your denominator is like a balloon.
Got it. Interesting. So a lot of people talk about buying into capital efficient businesses, and that's why a lot of these FMCG stocks, are looked at in those lines. But what you're saying is a little different. You're talking about businesses which could be capital intensive, but at the same time they're managing the base. When you're talking about ROC, and even in bad times they're able to manage that or reduce that by repaying debt, buying back their shares, whatever it takes. And in a down cycle, you're just about managing your ROC. But when it turns around on the small capital base, when the EBIT sort of jumps, earnings before interest and tax jumps, that's when you see the big expansion of return, and that's when you make your money.
Exactly. So capital intensive industries are usually linked to inflation. And if it's an inflationary trend, anyone with an asset side will make disproportionate amount of return on equity or return on capital employed.
Inflation, because it feeds into their prices, but not in their sort of the asset base, which is already sort of sunken costs?
So any new capacity coming in is coming in at a
And
disadvantage.
much higher. So the new capacity is coming at a higher cost. That's what you mean.
Yes.
So they have a natural advantage over that.
Yes. And in a consumer business, and since you've addressed the consumer part of the business, or FMCG businesses, all the FMCG businesses take their capex through their P&L. Okay, which is basically the big chunk of advertising and marketing spends.
Got it.
Okay. And just to highlight the fact that these were companies that were very capital efficient even from 2000 to 2009. But they were very subpar in terms of return.
Yeah.
So if you just draw the graph of Hindustan Lever from the top of the tech boom to the top of
The 2008, it was flat.
Exactly.
Yeah.
Exactly. It was flat. It gave you no return, but it didn't lose its efficiency. What happened during that period of time is all the smaller businesses. So he was going through a rough period of time, and all the smaller businesses who could not invest in their business, which goes through the all
P&L.
sold off or got so
Consolidated.
there's no such, or at least in my experience, there's no such thing as structurality of a business. Every business goes through a cyclical phase, and which is why the emphasis, whether it is an FMCG business or whether it is a commodity business, stick with the large ones.
Got it.
If you think they've done extremely well, move to another industry, but move to a large company. Do not moving on a relative valuation on a large portfolio is a trap.
Got it. Okay. Moving on. You spoke about quality balance sheet. Now, this can mean many things to many people, right? What is a quality balance sheet from your perspective? What do you look for in a balance sheet to say, this is strong or this is weak?
Its ability to handle multiple cycles. It's as simple as that. How do you measure it? You're financially disciplined.
Mm-hmm.
Okay, and it all comes down to that. What is financially disciplined? Make sure that you do not capture too much of debt at the trough of the cycle or at the peak of the cycle.
At the peak, yeah. Mm-hmm.
Okay, at the trough of the cycle, a lot of investors try to say that let's pick up a company with the largest amount of debt. We play the financial leverage. Okay, I've gotten multiple requests for creating products like this. But remember, financial leverage plays up on the upside of the cycle. I create new capacity and run with that capacity. I do not sit with debt at the bottom of the cycle and hoping I'll come to the top.
Yeah.
If I go down with debt, believe me, the management psychology is not to expand or not to grow. It's just to pay back debt. And that's not how you make large amounts of capital money.
Got it. So it's got a lot to do with whether they can. A quality balance sheet is basically what you're saying is something that can pull you through a slowdown or a cyclical slowdown in an industry, and you come out on the other side. And if you come out, you already won half the battle because a lot of your competitors are gone, they're weakened, they're overloaded with debt and all that jazz. Okay. So we've discussed position sizing. We've discussed cycles in industries, how to pick the stocks. What else according to you goes into this cauldron, if you will, of trying to create a solid portfolio?
Don't be a slave to the index.
Okay.
Okay. I think a lot of and if tech was 55% of the index in 2000, you know what it got you to.
Mm-hmm.
If commoditized businesses and capex was 45% of the index in 2008, you know where you are. And in the same metric, if there's a consumer economy and a financial economy, which is 60% of the indexes, or was for 60%, no, it doesn't mean that the last 5 years of great performance looks great on the other side. Always challenge your assumptions.
Mm-hmm.
And I think that's where I see way too much of consensus trying to map yourself around a particular particular industry just because it's got a large weight of index.
And that's because people don't want to be wrong. Like they can always blame the index. So because if you go away from the index, you're sticking your neck out and saying, hey, you know what? The index is very weighted towards, let's say, Reliance, but I'm not going to buy it. So I may underperform or outperform, but this is me. But if you underperform, a lot of people are going to question you. And then you need to have the conviction to be able to pull through that, I guess.
Yes, I think that's why I say that if you have to create a longer term track record around or a very successful, you have to question the norm, or you have to challenge the norm, and don't be. And when I say don't be a slave to the index, because we've seen multiple cycles, not just in India, but across the world. And you started with the 80s, and 80s there was a company called India Steamship as a part of the index.
Scindia Steamships.
Yes, along with a company called Orchid Silk Mills.
Orchid I'm familiar with. Orchid, it was one of those bull market wonders and ultimately disappeared.
Yes, so they were all part of the index, and they're not material anymore.
Yeah.
Right? And we've seen how the evolution of the marketplace or industry takes place, and so does the marketplace.
Yeah. So do you get the sense that the index is ultimately reflective of the euphoria?
Yes, the index is reflective
in terms of the allocations, right?
The index is reflective of things that have already done well.
Yeah. But in the last few years, there's been a lot of study done on this, that because globally a lot of money flows into index funds, it tends to support this misallocation, if you will. And therefore you could end up being not wrong, you could end up underperforming the index for a very considerable period of time. How do you deal with that?
So the messaging is, it's different for an investor and it's different for a professional manager. Okay. For an investor standpoint, indices are participating. Okay. It beats inflation over long term, and it will continue to do that for a very long term. So I am not against index investing. So it has to be a fairly large part of your allocation. But if you're going to be a money manager, and if you're going to have active positions, make them active. So there will be phases in your entire career and the entire environment where you'll underperform the benchmarks, and there will be pressures that are there. But whoever said that managing other people's money is going to be easy, or managing your own money is going to be easy, right?
Yeah, that's true.
And it's not about creating volatility by moving out of this, by moving out of the core index composition. It's not like you're creating more volatility. Yes, you're trying to create alpha, okay, or you're trying to do better than businesses. And more importantly, you do believe that there are companies that can do better than those top 50 companies.
That's right. Yeah.
Right. And if you don't believe that there are companies that are going to do better than those top 50 companies, then obviously go back to the indexes.
You mentioned about managing money. Even for an investor, for an individual, is not that easy, right? So we'll talk about that, because I want to talk to you as an individual as well. But first, let's wrap up the professional side. Here's a fun question. When you look at industries, and you've been doing it for decades, tell us the most like a niche industry that you came across that really caught your imagination, like something which we would not think in the normal course of the day or research.
Well, 2007, I had a gentleman who walked into office and he walked in and he said, I just got half an hour, but because I have half an hour, I'm coming to make a pitch of this company to you, because we are having an IPO. Okay, he came in half an hour, had his spiel and went back again. He was in a very narrow vertical of an industry, of a category which belonged to an industry which was called innerwear and jockey.
Oh, wow. Page Industries.
Yeah, there's a half an hour meeting, right? And That was one. Second is that on day of listing, not too many people know this, but it was down 15%.
Oh, wow. I
Okay.
didn't know that. I'm not aware of that.
And I think even fewer people know this, that probably in 2002, and the reason why he raised money, he was over leveraged. If I'm not mistaken, he also had a bad credit rating, terrible credit rating, and okay, and that's how cyclically that business turned around completely post this.
Wow.
So what I did in Standard Chartered or IDFC was not very different. Okay, again, uh, uh, Vetri, my ex boss and mentor in
Kotak.
Kotak.
Yeah, Vetri Subramaniam. Yeah.
That's right. Uh, okay, he pointed it out to me. Just pick up a niche, okay, and wait till it turns into an industry. There were very few mid-cap funds that were there. Okay, and the two that did well from the late 90s to the mid 2000s were actually having their own cyclical problems of performance and size. And what I did was no rocket science, because it was basically an industry with no competitive intensity. And we went on at least till 2010, 11, we were amongst the largest in the mid-cap space. And post that category became the largest. It became bigger than large cap.
Interesting.
So,
yeah, this point you make, look for a niche and wait for it to turn into industry. I'm going to talk about this right now. But about Vetri, if I recollect well, he used to manage a fund called K30. And I remember it doing very well. So is that where you got your 20-30 stocks kind of mentoring,
yes,
if you will?
yes, I think I was given the MNC fund when he was around.
Okay. Yeah.
So we were all in that basket. There was a tech fund which was also running about 10 companies. There was an MNC fund which was running 16, 17 companies, and there was Kotak 30 which was running 30.
So you had all your grooming phase, initial phase in tight portfolios, and that works for you.
Yeah, optimize the box.
Optimize the box. Wonderful. Okay, now talk to us more about look for niches and see them go through becoming an industry, right? And ride that whole process. We spoke of innerwear. Any more stories come to mind from the past where you saw this happen?
Balakrishna Industries.
Tires.
Off-road tires.
Off-road tires. By the way, both Page and Balakrishna are Equitymaster recommendations also. I should disclose over here. They bought them like 10, 12 years ago in their portfolios, in their recommendation services, sorry. Even I guess footwear. Even footwear, I think, was all unorganized and very few players were there. Are you seeing any niches now that you find interesting and have a potential to become large in the next 5, 10, 15 years?
They come through. I don't say there's nothing available out there. I think I don't know how it will play out, but the most underinvested in industry in the entire world is agriculture.
Yeah.
The only investment that has gone into agriculture has been subsidy across the world. So there's been a very inefficient allocation to productivity in that industry. I don't know how it's going to change, but I'm definitely sure that over the next couple of years, there will be a significant investment and return in businesses out there.
So I guess in agriculture, let's talk about agriculture a little more. That if you had to make a call on agriculture, you would also have to effectively make a call on the politics of the day, because it's so intertwined, right? And maybe that's why it's in the state it is across the world. For some reason, agriculture and politics are very deep. I mean, it could be because of food, right? Ultimately, it goes on every table, and that's what controls inflation costs, and that has impact on your future prospects as a politician.
So I wouldn't debate any of that. There are enough negatives not to hold this business. But I just come from a perspective that there are very few people who want to invest in that industry in the first place.
Oh, yeah. That in itself is a reason to look at it, right?
Okay, so I wouldn't even know how contextually to say how it will play out, because Frankly, I didn't even expect an innovative company to trade at 40,000 crores of market capitalization from 350 crores of market capitalization, right?
Mhm.
So it pulled up, it made that industry mainstream. And then you had a footwear company who also trades at about 15, 20,000 crores of market cap. And it came from nothing.
Yeah. And in and agriculture, is there any like you include the whole bucket, be it fertilizer, chemicals, etc., the whole
Yes,
thing? Yeah.
there's a lot of things that goes into into that industry.
Yeah. Okay. So let's move on from stock portfolios. I think we've discussed that at length, and I think the readers are going to have quite a bit to chew on when they're looking at their portfolios after watching this video. Asset allocation. And I'm talking about Kenneth as a person when he's looking at asset allocation. What are your thoughts? How do you think about allocating money when you're looking at your overall wealth?
So I have very little fixed income equal to nothing. So whatever my fixed income portfolio is probably sitting in real estate, and that also most of it I use.
Okay. So
But that's
you bought your space, your office. Is that your investment in real estate?
Yes. So that's essentially what our fixed income is. But a large part of it or a significant part of it is our own portfolios and equity.
Okay. What are your thoughts on gold?
So I haven't stepped out of what I do, right, in terms of asset allocation, and I think if I was to play an inflation hedge, I'd buy companies which have assets on the ground.
Okay.
Right, commodity business, a real estate business, a manufacturing capacity which is fairly efficient. Those kind of businesses. So I think it takes care of itself. I haven't been a very big fixed income fan, or I haven't really sat down any time and looked at my asset allocation ever.
You're doing the same thing, right? Over there, you're picking the winners, and the allocation is going to get decided over time.
Yeah. So yeah, it's not probably the best way to do it, but I haven't had a reason to complain till now.
Yeah. So one of the reasons I talk about asset allocation a lot on this podcast is because, like I was saying in the beginning, I believe that in the long run, and I think there's studies to prove that, a lot of your wealth would depend on how you allocate.
True.
And one of the reasons it does that is by controlling the bottom part, the losses. Because, if someone went long on real estate in 2008, 9, 10, and I talk, they've had a 10, 15 year of underperformance. Now, if they did that to the extent of 20%, they're still fine. No worries, because the rest of the portfolio did something. But if they went all in, to hit that lottery, to get the jackpot, if you will, that's a terrible, experience. So I think for a lot of people to allocate well. So when we talk about, we spoke to Mark Faber the other day in our podcast, they all believe in allocation. And of course, it changes. Mark's is very simple, 25, 25, 25, 25. Do your stocks, you do real estate, you do bullion, and you do cash and bonds, right? I spoke to Alok Jain the other day, the weekend investing, initiative. And I think it was him who said 1/3, 1/3, 1/3. So everyone's got their own thumb rules.
Yes.
And I think it helps control the biases you may have, which are triggered by, what's happening around you. But I guess you're a very disciplined guy. You don't need to go through that process.
No. It does hurt at points in time, but really, the cycles get you used to it now.
That is right. That's right. Fair point. Okay. One question about here and now. So we're coming off a lockdown. We've come off a lockdown actually quite some time back. But let's say we're coming off a lockdown, and your wife comes to you and says, "Hey, Kenneth, we were locked up in our homes. I happened to save 1 crore of rupees in this last couple of years. And here it is. What do you want me to do with the 1 crore? What would you tell her? What would you recommend to her?"
Spend it.
Spend it on what? Go on a holiday?
Yes, I think 2 years staying locked in is not probably the best way to spend the last 24 months, the last 2 years.
That's
So
right.
yeah, I think the whole world is an outing.
The whole world is around, and that's reflective in the markets, right?
Right.
Anywhere you go for a holiday these days, the hotels are full, the rates are sky high. It's amazing. I think I don't know whether it's going to be permanent. They say I don't know whether it'll be true of this, but they say that if you do something consecutively for 30 days, it becomes a habit, right? So so for 2 years we stayed at home, or 1.5 years we stayed at home. So work from home is becoming a habit. Now I wonder whether when people start traveling, the revenge travel, whether it'll become a habit and people will kind of travel more.
That's an expensive hobby.
Travel is a very expensive hobby, especially these days, right?
It's always been, but yeah, it's all. I don't think it's ever changed. But yes, especially so today. Travel's not. You need time, and you need the money.
And you need the money. That's right. That's right. Okay. What are you reading these days?
Okay. Right now I haven't picked up something for a long time. So I can't say I'm reading anything at this point.
You're probably reading like dozens of annual reports as they trickle in for this year.
The annual reports are part of the assignment that I'm always happy to take on, and that's normal. But
any particular annual report that you would advise people to read, just for the learning process, how a good balance sheet looks like?
Actually, the last 2 years, if you can pick up any of the commodity balance sheets, especially the steel balance sheets, it'll show you as to how it'll show you how much cash flows are important to any business cycle.
Okay. You said steel. Let me. So just I heard you right. Steel. Okay.
Yeah. I think if you pick up those, it'll give you a fabulous transition of how a business cycle works. And you don't have to look at it for 10 years. You pick up 2010, 11, and you pick up 2020, 22, 21, 22. It'll give you a fabulous convert. You get a whole picture of the entire cycle.
Wow. Okay. Any particular? I'm going deeper because you read annual reports a lot, I assume. Any management that you see really gives a very nice articulation of business, industry, economy that people should read to just get a nice perspective on what's happening?
So it goes back again. I mean, obviously, the larger companies have a better perspective of what's happening in and around their environment, right? So if you pick up the largest FMCG companies' books, okay, you get a full overview of what's happening with the economy, and just going granularly down to bits and pieces of how that industry is transitioning. Right. If you and I've been there and take a look at the financial statistics of the world's largest steel companies, ArcelorMittal, has been fabulous.
Sorry, can you repeat that, please?
ArcelorMittal.
ArcelorMittal. Okay. Sorry.
Okay. The financial transition of that business is fabulous, and it'll also give you an insight. Okay, and his annual report also gives you an insight as to how the business is transitioning in line with how climatic changes are, how the world's largest polluting industry is transitioning in line with norms which are changing. Yes, with norms which are changing. It'll also give you a sense of where the next couple of rounds of transition or next couple of rounds of where capital is going to get invested.
Yeah. So you mentioned steel. So if I may just share, I was reading about steel the other day, and they said, do they call it green steel or they don't? I'm not sure about whether they call it green steel or not. And they spoke about how these companies are starting to try two things, right? One is how they, of course, how they burn gas or no gas and use hydrogen, etc., etc. The other was the carbon capture thing.
Yes.
Since you mentioned, since we talk about this, how critical is ESG when you are looking at stock selection? Do you think it'll have a material impact on performance in the years to come?
Yes.
You think so?
So I must say that it's not really top of the priority for people sitting in this part of the world, including myself.
And that's because the money that is coming to you is not money that is being invested. The investor is not asking for it to be a factor. Like in the US and all the pension funds say, you have to comply with all those things.
So we don't invest in, so I can say this much, that we don't invest in a company or in a business. We're deliberately wanting to capitalize on flouting in future environmental norms,
Yeah.
or have an arbitrage on environmental norms based out of India compared to the rest of the world. We don't do that. So we're fairly, I mean, you might want to call it conscious. You might want to call it conscious, but we're fairly conscious over that matter.
Mhm.
So we got very few companies that, or virtually non-existent companies as far as the chemical business is concerned. Okay, we used to hold just one company, and they also had a reasonably state-of-the-art plant. So when talking about this, yes, it's going to be a fairly important topic as we go down into the next 3, 4, 5 years.
Very interesting.
I think the problem is more nearer than we think it is.
Yeah, I think Aswat Damodaran said that he doesn't care for it much because I hope I'm not misquoting him, but he said he doesn't care for it because in all his study he did not find uh, anything. Whether it was really ESG making an impact in some sense or the other. A lot of a lot of these ESG indices have tech stocks, which anyways would not have had, like a ESG saving, a net saving. On the flip side, and I'm sure you've read this, I think Terry Smith recently wrote a letter in which he castigated one of his uh, holding companies, PayPal, I think.
Mm.
And he said that, quit focusing on all this stuff and get down to business. Get your business right and be a good corporate citizen. And don't let that precede business. So I guess it's going to be a tug of war in the next few years. How it
So
goes.
you need cash flows to be compliant, right? So
Yeah,
you can't just focus on compliance and lose sight of your cash or lose sight of being competitive.
that's right. It has to go kind of hand in hand now.
Yes, it has to be. You have to invest with existing cash flows,
Mhm.
and I would think before we get fully compliant with new energy norms, which are non-polluting, we will pollute more before we get completely compliant. It's a cycle which will be very material intensive, and to produce all that material, I mean, there's no simple solution, and it's going to be green.
Yeah, yeah, I hear you. Okay, Kenneth, my final question to you. Uh, I'm I'm looking for what someone like you who's been around for over 30 years, managing money, tracking the markets, managing money, writing about the markets, etc., etc. Uh, what would you have to say to the listeners of this podcast in kind of in summation, if you will, that if they had to sort of uh, become successful money managers for their own money when it comes to the stock markets, uh, in sort of summation, uh, what what is the approach they should take, or what is the advice you would give? What is it that they should avoid? The pitfalls, if you will.
I guess a lot of investors, or I should say, there's just one sentence. I wrap it up in just one sentence. Just stay the course.
Okay.
Okay, just do what you do and just stay the course. And don't experiment too much. Just continue to do what has worked for you, because we always have one stock that has worked for us. Go back to that one company, one stock, one fund, and figure out what has worked for us and make that a habit. Keep repeating the same process again and again and again till it becomes a habit. Because after a particular point in time, you just stop making mistakes. So investing is not about all your successes; it's how much less mistakes you make.
Mistakes you make. Yeah. I think that's one of the underlying themes of what we've discussed today, actually. Okay, yeah.
So if you stop making mistakes, your strike rates will be extremely high. But to get to that point, you have to stay the course.
Very interesting. On that note, which is a very, very thought-provoking note. And if I may add, it reminds us of, sorry, excuse me, it reminds us of rule number one of Mr. Buffett. Don't lose money and don't forget rule number one. On that very simple but yet very powerful note, I would like to thank you for taking an hour out and talking to us at the Investor Hour. And thank you very much for all the wisdom you've shared today on how to build a portfolio and how to go about looking at cycles and picking stocks.
Thank you, Rahul. It was a pleasure talking to you. Okay.
Wonderful. Thank you. Thank you, Ken.
And all the best.
Thank you.